Today the Fear and Greed Index sits at 69, signaling greed is back in crypto markets. That appetite for risk can fuel rapid price moves, but it also raises the risk of sharp pullbacks if momentum fades or headlines shift. In the near term, greed can push prices higher as new entrants chase gains, testing support levels and triggering short-covering spikes. In the medium term, sustained greed could push BTC and major alts toward fresh highs, yet a sudden macro surprise or regulatory snag could snap sentiment just as quickly. Stay disciplined, manage risk, and watch for divergences between price and momentum. Diversification remains essential for navigating a crowded market. Bitcoin traders are eyeing a potential short squeeze. Bitcoin is nudging higher. A 10% move could unleash $18 billion of liquidations. This would accelerate price discovery toward $120,000. The setup relies on rising momentum, unwinding leveraged positions, and crowds moving into the long side. If the price breaks new intraday highs, altcoins often ride the wave. This increases liquidity across the market. In the near term, risk controls and stop losses matter as volatility ticks up. In the medium term, improved profitability for miners and holders may unfold if the trend persists. In the longer term, macro factors and regulatory whispers will frame a ceiling. Traders should avoid overexposure and stay prepared for reversals. Ethereum has broken through the $4,000 barrier, and analysts weigh ambitious targets. The most optimistic voices point to a rally toward $10,000 or higher within 6 to 8 months, propelled by scaling upgrades, demand for Ethereum is collateral, and growing institutional interest. Skeptics warn that volatility, high gas fees, or shifting regulation could pause the rally. In the near term, expect consolidation as traders digest the breakout. This could be followed by renewed liquidity if the narrative holds. For traders, pullbacks may offer buying opportunities. For investors, a longer horizon could amplify Ethereum's influence on other tokens. Risk management and careful sizing remain essential. Investors have funneled more than $1 billion into futures-based SOL and XRP ETFs since their launch, signaling a growing appetite for crypto exposure, even before spot vehicles catch up. The inflows suggest institutions are testing the waters in a regulated wrapper, potentially improving price discovery and inviting new buyers. If this trend continues, SOL and XRP could attract more liquidity, lifting trading volumes and volatility. The development may spur broader ETF chatter and more product launches. This could feed a cycle of inflows into crypto assets. Caution remains. Futures-based products can diverge from spot prices, and roll costs may weigh on near-term returns. Overall, this indicates a positive longer-term trend for mainstream access. Bitcoin Hyper promises a Layer 2 solution to dramatically boost throughput and cut confirmation times, addressing a long-standing bottleneck in the network. By delivering faster, cheaper transactions, it could widen merchant adoption in microtransactions. It could potentially attract new users and capital. The project faces competition from other scaling options and must prove security and compatibility with Bitcoin's base layer. If it gains traction, expect a gradual, positive impact on on-chain activity and network reliability. Risks include integration hurdles and the pace of user adoption. In the near term, sentiment may spark speculative bets, but the real impact depends on real-world usability. Dogecoin shows renewed bullish momentum, carving a rising path and drawing fresh retail interest. The MAXI presale tempered the narrative and could offer high-risk, high-reward dynamics for new entrants. If the trend persists, expect further upside with volatility typical of meme tokens. The MAXI presale adds risk, including project risk, liquidity concerns, and possible unlock sell-offs. For crypto markets, a sustained Doge rally could lift sentiment for other meme coins and speculative alts, supporting near-term inflows. In the medium term, the Doge story will hinge more on social momentum and macro conditions than on fundamentals. Traders should manage risk with measured exposure and clear exit strategies. Security researchers warn about GreedyBear, an industrial-scale crypto theft ring accused of multi-stage exploits that have stolen more than $1 million. The operation highlights ongoing vulnerabilities in wallets, phishing, and browser-based attacks. In the market, it reinforces the need for safer custody, robust audits, and user education. In the short term, risk premiums may rise in affected assets, particularly micro-caps and DeFi projects with weak controls. In the medium to long term, renewed emphasis on security could push developers to harden protocols. This would boost trust and adoption. Traders should diversify risk, use trusted infrastructure, and follow best practices when moving funds. Federal Reserve Governor Bowman has urged 3 rate cuts by year-end, signaling a more accommodative stance on policy. For crypto markets, Easier monetary conditions can soften the dollar and lift risk appetite. This could fuel inflows into Bitcoin and altcoins as investors rotate from safe assets to higher risk bets. The immediate effect could be a liquidity wave supporting prices. The longer-term impact depends on macro resilience and regulatory clarity. Traders may see more leverage and appetite for speculative bets, but volatility could stay elevated as markets process policy signals. Crypto remains sensitive to macro policy, but the near-term trend looks cautiously constructive. Markets show a telling split. Algorithmic traders are bullish on equities, while human traders grow cautious, highlighting a mixed risk-on mood. For crypto, the gap can spill into digital assets as quant-driven liquidity pushes prices higher, even amid fundamental skepticism. In the short term, expect choppy action as momentum chasers collide with hedges. In the medium to long term, if macro conditions improve, crypto may see broader capital inflows and higher correlations with equities. If sentiment reverses, crypto could suffer swift pullbacks. The key for traders is to monitor cross-asset flows and maintain disciplined risk controls, recognizing that a machine-led rally can reverse without warning. Hedge funds are pivoting away from traditional energy bets, seeking new narratives as oil and energy market dynamics shift, affecting volatility and profitability. The shift could affect crypto mining economics if energy costs tilt toward renewables or cheaper power, potentially altering mining margins and network security for some networks. In the near term, cross-asset volatility could weigh on risk assets, including crypto, as energy and tech cycles rotate. In the medium term, capital may move towards sectors with stronger growth or resilience, including crypto-enabled technologies. As always, investors should weigh energy, macro, and policy signals together, because energy moves can cascade into crypto demand and network activity. Carried trade activity is heating up in emerging markets as traders anticipate a weaker dollar and higher yields. For crypto markets, this can mean greater liquidity and risk on sentiment if global funding conditions ease. In the short term, dollar softness can support risk assets and inflows into Bitcoin and other cryptocurrencies. In the mid-term, broader liquidity could lift valuations across the space. Policy surprises could inject volatility. In the long term, a persistent risk-on regime may correlate crypto with equities more closely. Traders should monitor currency moves, inflation, and central bank signals. Cross-border flows often drive crypto volatility and speculative flows. Pacific Equity Partners is nearing a deal to buy Spark New Zealand's data center assets, valuing them at hundreds of millions of dollars. For the crypto sector, more data center capacity can feed hosting, validation, and cloud services. This could lower barriers to scale for some networks. In the near term, deal activity can lift sentiment around infrastructure and its role in crypto ecosystems. In the medium term, more compute and storage capacity may support broader blockchain services and research. Regulators and energy costs remain key. While the immediate impact may be nuanced, the longer-term tailwinds could bolster confidence in crypto infrastructure investments.